Saurabh Mukherjea graces us right here in our studios and is giving us his insights on the markets. What should the markets be bracing for, Saurabh? Good morning.
I think you mentioned several brokers have mentioned already that the fall in oil is good news for India. It is for the fisc and for the 10-year bond yield. But what I find very interesting is the 3-month commercial paper rates are not showing any great joy. And my reckoning is that there is plenty of liquidity tightness in the money market, which obviously has ramifications for the NBFCs and for our broader car financing, house financing sector. I think that suggests caution is still warranted in this whole sell-off that we've had since the ILFS debacle broke out. And my reckoning is over the next 12 months, focusing on quality banks, well-run, high-quality banks with great CASA, strong IT companies, strong pharma companies would be my tactical positioning in the portfolio. My structural positioning, as I've sort of said several times on your channel, is buy great compounders and hold them for a long time. But if you ask me for my tactical positioning, I think well-run banks who've got strong capital buffers, strong CASA franchises, I think are really well set for the next couple of years. It's pretty clear that the old financing construct that NBFCs were relying upon, which is go to the mutual funds, get them to buy your CP, that construct is gradually being replaced by a very different funding paradigm, which suits the banks just nicely.
So you're stretching that pool beyond ICICI Bank or Axis as well, because that seems to be getting to a overcrowded zone now. I think
Kotak and HDFC Bank would be my default go-to place to place the strategy, because you also need banks with proven track record of choosing the right credits. I think it's a little difficult to look at the larger banks today and look beyond HDFC Bank and Kotak and say who else has successfully managed the credit cycle for 10-15 years. Amongst the smaller banks, conservatively run banks like City Union, like DCB Bank, I think are also well placed. But I think well-run banks with strong capital bases are really well placed for the next couple of years. You can see the tightness in car fund.
Your preference is not towards ICICI Bank?
No. So I'm saying ICICI Axis I would still stay away from. I'm still not sure of their credit selection skills. Axis is going through a management change. I think it will be quite a comprehensive management change in Axis. So I think we should wait and let the new management come in, let them settle down. And in ICICI's case, the credit selection skills have been found wanting for a long time. So HDFC, Kotak, smaller banks if you wanted to look at than City Union, DCB, but I think there's a pronounced funding challenge in our country, and well-run banks will be the beneficiaries of that funding challenge.
Why Kotak? Because Kotak doesn't have a strong liability franchise. I mean, they are borrowing at 6% CASA.
Right. So 33%, I think 35%, mid-30s CASA, big buffer on their tier 1. And my belief is that the combination of the old ING franchise, the new Kotak franchise, and their ability to improve deepen the franchise should give them reasonably good funding access over the next couple of years. The tier 1 buffer, Nikunj, I think is something to focus on, because if you have a tier 1 buffer, you've kept your powder dry. I think over the next couple of years you'll get good opportunities to lend at very good interest rates.
I want to go back to this whole belief which everyone has around IT now. IT in a sense was the go-to trade for the first half of this year. TCS, Infosys, they made good returns. But when I looked at the numbers, none of the IT companies reported great expansion and margins. None of the IT companies came out and told us that, it's looking great. And we're going to be making hay when the sun is shining. The incremental commentary was positive, but it was not great. And when it comes to mid-cap IT companies, the performance and delivery was also not there. Mindtree struggled, Hexaware struggled, Persistent has been struggling for the longest time I can remember. That happened when rupee was at 74. That happened when IT companies enjoyed a dream expansion in margins because of currency. That could change.
Yeah, so look, I think the first thing to realize is, given that most of these firms hedge their currency exposure a good year ahead, the benefits of a currency slide takes some time to materialize, and the slide in the rupee has been so rapid from 64 to 74 and now to 71 that I don't think the rupee slide, both the slide to 74 or even the pullback to 71, is as yet showing up in the numbers. I think it'll take a couple of quarters for that to show through. What I'm more convinced by is you can see the tightness in the IT job market. I think this is the tightest market for IT professionals I've seen for 7-8 years.
Tight, you mean to say there is lack of talent availability?
There's lack of talent. There's immense demand for IT talent. I think Bangalore and the other IT hubs like Pune, like Gurgaon are seeing immense demand for IT talent, which suggests strong recruitment activity. You're seeing that on university campuses as well, which suggests that the IT management teams have visibility on demand, which they might or might not have given you and me full visibility on. Beyond that, US banks are in good shape. US banks are big buyers of Indian IT, and the other element is, I think, 5G, which will gradually come through in the next 2-3 years, will be a big source of work for the Indian IT firms. So I think there's good reasons to believe the work pipeline is solid, and even rupee at 71-70 is a better place for these firms to be than a consistent rupee at 64-65, which is what they had for 4 years. I think that really kicked the sort of wind out of the IT firms. 4 years of rupee at 64-65, I think, punched the living daylights out of these firms.
Beyond IT, you also continue to like pharmaceuticals, but I'm guessing that's a more selective approach, right?
So what I think where pharma got again smashed was not just the FDA issues, which I think are well understood now, but again 4 years of rupee at 64. These companies, after all, are remaking American generics. They need that currency tailwind to give them a bit of a boost. Again, rupee going from 64 to 71 should help them. But beyond that, I think the worst of the FDA issues are past. As you can see, the news flow, even if I watch your channel, the news flow on the FDA front is gradually abating. And I think the firms with stronger chemistry skills like Dr. Reddy's, genuinely deep chemistry skills built over 20-30 years, I think are looking very attractive to me. So if you ask me the frontline IT firms, a Dr. Reddy's, a Cipla, to my mind, a Dr. Reddy's or a Cipla, to my mind, make a great deal of sense to look at. And if you wanted to go down the market cap spectrum, say a well-run mid-cap firm like Torrent Pharma is also worth looking at.
Why Cipla? It's not here, it's not there. When I say it's not here,
right.
I mean it's not India, it's not US.
Right.
They're trying to position themselves as a semi-regulated generic company.
Right. So two elements to that, Nikunj. First, if you look at the Indian domestic data on generic demand, I think we've had 5 consecutive years of more than 10% YOY volume growth in generic demand. This is
the medicine about domestic
consumption. 5 consecutive years of 10% every single year volume growth, which makes sense, right? As the lower income people get a little bit more money in their pocket, they're spending more on life saving, on essential drugs. And the second element to Cipla is, I think, is just too cheap to be ignored. It's such ridiculous for a firm with, again, strong chemistry skills. I think Yusuf Hamid's legacy has been very strong chemistry skills. I know results have been weak for 2-3 years, etc. But domestic strengths, chemistry skills, and too cheap to be ignored.
Why not buy an Abbott or a Pfizer or a Glaxo? I mean, you're purely betting on the fact that Indians would be consuming better medicines. We had the management of Abbott a couple of days ago, and the thought which came to my mind was that, okay, oh my God, they control the entire thyroid care market. Suddenly we realized that you got Pfizer, which is controlling your Bicosol market. So there are a lot of these big MNC players which could really benefit.
So Abbott is a cash machine. It makes it to my consistent compounder portfolio. It's got I think almost a complete, almost a quasi monopoly in some elements of therapeutic care.
But
it's a domestic play, and I like it for that. So it's in the consistent compounder portfolio. A Cipla or a Dr. Reddy's, the underlying chemistry skills give the firms, I think, a greater ability to accelerate. But as a steady compounder over the next 3, 4, 5 years, I think Abbott should be in there in a classy Indian portfolio.
Retail, is it just suddenly, emerging from the ashes, given what's happened with, the story that's breaking? Jeff Bezos looking at India?
So look, I think as long as I've been in India, I've been hearing about MNCs buying Indian retail. It's one of those sort of staples of Indian business life. I'm not so sure I would buy too many retail stocks. Whilst companies like Trent and DMart are spectacularly successful and clearly very well run, beyond a Trent or a DMart, I haven't seen too many well-run retail plays in India where I'm convinced they'll make a return on
Do you think that would be changing? That's my question, because one of our colleagues from the Economic Times, Arjit Berman, just came out with the story this morning, and he's gone down to the numbers, to the specifics, how much debt, how much needs to be restructured. So it seems like Jeff Bezos is coming through a well thought out plan, and that could just revolutionize the way retail is run in India.
I mean, I'm not on top of the specifics of the future Amazon situation, but if you step back and look at it more holistically, cost of capital is rising in our country. Already when cost of capital was low 2-3 years ago, our retailers weren't able to deliver return on capital above cost of capital. As again cost of capital drifts up over the next couple of years, I'm not so sure there's a great story. I think that's the fundamental challenge in Indian retail. Very few guys make money in excess of their cost of capital, and Trent and DMart therefore stand out in the sector.
I want to go back to this theme which we've discussed again and again. I'm getting more and more convinced about that theme, which is that when you borrow money, it doesn't matter whether you're borrowing from Union Bank or SBI or ICICI Bank.
You bothered about the rate.
You bothered about the rate, and you bothered about what your loan approval is. But when you give money to manage someone, you do your checks and balances. What has been the past return, what is the brand, what is the nature of the fund manager. So if I have to put that criteria, and if somebody is not giving you money but wants to let's say bet on the fact that financial inclusion is going to grow, which is one asset owner or money manager you would bet on, which could be part of your constant compounder list? Will it be Motilal, will it be HDFC, will it be Reliance?
I think to be fair to our fund management community, I think in the PMS and AIF construct, you've seen several fund managers come out and do that. These guys have built portfolios where they're buying companies which broadly fulfill two criteria: return on capital above cost of capital for a long period of time, and alongside that steady growth in the business. And I think the success of the PMSs and the AIFs in doing it has been the key driver why this space has gone from, I think, almost no money 5 years ago to close to $40 billion of assets under management.
They're managing more money than insurance now.
Yeah, so 0 to 40 billion in 5 years. And in that same time, if you look at the mutual fund, the equity mutual fund, large cap equity mutual fund track record, it hasn't been that much to write home about. And I think this disconnect continues, and I think alternative assets in India over the next 10 years boom. I think I told one of your colleagues, Ajay, in an interview, that I reckon a decade hence Indians will be saving around $1 trillion a year. Every year we will save $1 trillion of additional financial savings. And just to put that number in context, the total mutual fund equity pool today is 140 billion, right? Just the total pool that we've created in the last 30 years is 140 billion. And I think we're heading in a direction where every year we'll save $1 trillion a year. So the space, I think the opportunities are there for the MFs, but even more so for the alternative fund managers, which is why you're seeing good talent come into this space.
That's a great big picture argument. But for example, somebody says, look, I want to bet on this business where if you're saving $1 trillion, MFs will become big, EIFs will become big, everybody will get more money to manage. But as a franchise, what would you bet on, or as a stock, which would you bet on? Would you bet on HDFC AMC? Would you bet on Motilal Oswal? Would you bet on?
So as a stock, I would say, I think now that that Aspire housing finance thing has been sort of sucked out of Motilal's stock price, and you no longer have to bet on Motilal and worry about the housing finance industry. I think Motilal as a well-run long-term play on savings in India does make sense. I mean, I wish that. I wish the Aspire housing financing had never happened, but it is what it is. Life, we're all in our capital allocation decisions. We're all allowed to be human, but their asset management business, their broking, their wealth management business has got strong legs to benefit from this financialization of the Indian economy.
Why not IIFL Holding or HDFC AMC or?
So let's take it one by one. So I think in IIFL Holdings case, they've got two NBFCs, right? One above and one below. I think my views on NBFCs are relatively well known now. In HDFC AMC's case, the mutual fund point that you've got the large cap equity MFs in our country, almost overwhelmingly all of them have a big challenge. It's very difficult for the large cap equity MFs now to generate meaningful outperformance, and that constrains the long-term growth.
Soon, Saurabh, we're going to be staring at the state election results as well. How critical and how volatile do you think the market can get around the December 11 event?
So look, I think two ways to answer the question. If there are adverse outcomes for the ruling party in Delhi, will there be a market pullback? There probably will be, given that lots of people have entered the market over the last 3-4 years with a political sort of mindset. But if you ask me, is there any long-term implications for the stock market? My answer will be an emphatic no. There's nothing in Indian political data, economic data to suggest that the identity of the party winning the elections at the center, let alone the elections as a state, has any great fundamental bearing on the economy. I know we all like the drama, and I like it as much as anybody else, but we have to be, if we are honest about the whole thing, we have to say neither the opinion polls nor actually the announced results, the actual results, have any long-term bearing on the stock market.
But in the short term, you do sense this is going to be a volatile.
True, clearly, because as we all know, there's a whole generation of investors who entered the market through the last 3-4 years with a specific political mindset.
No, but if you, so just adding to Ayesha's question, if you zoom out and you look at what the markets can do ahead of the general elections, tie that in with what the global environment will look like in 2019, what would be a larger portfolio construct that you would want to approach markets with?
So I think and there are plenty of uncertainties out there, and I'm not the expert who can bring it all together. The way I'm simplifying it for myself is, I think cost of capital, uncertainty in cost of capital goes up. As cost of capital goes up, well-run banks who have capital buffers do well. IT and pharma companies who are capital light do well, and they benefit too from any weakness in the rupee that we see and we might see going forward. And beyond that, classical compounders, companies with consistent compounding, and we discussed Abbott Labs, you could throw in their Asian Paints, you could throw in their Pidilite. These sorts of companies do well. So you're playing the tactical piece through banks, IT and pharma, and you're playing the structural piece through the standard story that we've been discussing here on classical compounders, consistent compounders.
Well, fantastic. Always nice to have you on the show. Thank you for joining us. Marcus, meanwhile, if I turn my